Let me start with a hard truth most people don't want to hear. War is tragic. War destroys lives. War creates chaos. But financially, war has always created winners. Not for soldiers, not for civilians, but for capital. And whether you like it or not, markets don't move on emotions. They move on incentives, supply shocks, fear, and government spending. Today's video is not about politics. It's not about morality. This channel is about how people make money. And historically, some stocks and commodities don't just survive war, they print money during it. So today, we're breaking down stocks and commodities that historically perform best during wars, global conflicts, and geopolitical chaos, and why money flows into them every single time. Watch closely, because the biggest mistake retail investors make during war is reacting emotionally while smart money positions early. Let's start with the most important concept. War does three things to markets immediately. First, governments spend massive amounts of money. Second, supply chains break. Third, fear spikes, and fear changes where capital hides. If you understand those three forces, you understand how to profit. Let's begin with the king of wartime assets. Gold. Gold is not just a shiny metal. It is fear insurance. During war, investors don't ask, how do I grow fast? They ask, how do I not lose everything? And historically, when missiles fly and currencies weaken, money runs to gold. Why? Because gold holds value when currencies are printed. Isn't tied to one country, has survived every war in human history. During major conflicts, governments print money to fund war efforts. That weakens fiat currencies. Gold benefits directly. This is why central banks stockpile gold before and during conflicts. It's not tradition. It's protection. Gold doesn't always explode overnight. But during prolonged wars, it quietly preserves and grows wealth while everything else shakes. Next, oil and energy stocks. Wars are fought with energy. Tanks don't run on hope. Jets don't fly on speeches. They run on oil. Any conflict involving major regions immediately threatens supply. And when supply is threatened, prices rise. Oil spikes during war for three reasons: supply disruption sanctions, military demand. Energy companies don't need peace to make money. They thrive on instability. Oil producers, refiners, and energy exporters historically benefit when conflicts escalate, especially when wars involve oil-producing regions or major trade routes. Even the fear of disruption can send prices up before a single barrel is lost. Energy is leverage, and war magnifies it. Now let's talk about defense stocks. This one is obvious, but still misunderstood. When war breaks out, governments don't ask, can we afford defense spending? They ask, how fast can we scale it? Defense budgets explode during conflicts. Contracts get signed. Production ramps up. Defense companies don't depend on consumer demand. They depend on government checks. And governments always pay. Weapons, ammunition, aircraft, surveillance systems, cybersecurity, these are not optional during war. Defense stocks tend to rise not just during war, but before and after, as countries prepare for future conflicts. War doesn't end defense spending. It locks it in for decades. Next, commodities tied to survival and infrastructure. War destroys infrastructure. Then it has to be rebuilt. This is where industrial commodities come in: steel, copper, aluminum, rare earth metals, tanks, vehicles, buildings, power grids. They all require raw materials. Copper is especially important. It's used in weapons, vehicles, communication systems, and rebuilding cities. During war, supply chains break while demand increases. That imbalance pushes prices up. Commodities don't care about earnings reports. They respond to real-world demand. And war creates demand at scale. Now let's talk about a quiet wartime winner most people ignore: agricultural commodities. Food becomes strategic during war. Fertilizer, wheat, corn, soybeans. Conflicts disrupt farming, transportation, and exports. That reduces supply. Prices rise. Countries don't gamble with food security. They stockpile. And when governments stockpile, prices spike. Agriculture doesn't just benefit from war, it benefits from fear of shortages. This is why food prices often surge during global conflicts, even in countries not directly involved. War reminds the world that food is power. Next, defense-related technology and cybersecurity. Modern wars aren't just fought with weapons, they're fought with data. Cyber attacks, surveillance, satellite systems, intelligence software. Governments and corporations increase spending on digital defense during conflicts. Cybersecurity firms don't need bombs to fall. They just need tension. Because during war, cyber warfare becomes constant. This sector benefits from government contracts, corporate panic, national security spending. War accelerates tech adoption, especially defensive tech. Now let's flip the perspective. What usually loses money during war? Consumer luxury, travel, hospitality, speculative growth stocks. Why? Because during uncertainty, people stop spending. They conserve cash. They prioritize survival. Money moves from risk to safety, from growth to defense, from dreams to durability. Understanding this rotation is how smart investors stay ahead. Here's an important warning. War does not mean markets go straight up. Volatility increases. Swings get violent. Headlines move prices faster than fundamentals. That's why timing and positioning matter. The biggest gains often happen before war officially starts, during escalation, during prolonged uncertainty. Once peace is announced, many war-driven assets cool off. Buy fear, sell relief. That's how markets behave. Now let's address the moral discomfort. Talking about making money during war feels uncomfortable. That's normal. But ignoring reality doesn't protect you financially. Governments, institutions, and corporations don't stop operating because of war. They reallocate capital. You can either understand where money flows or get crushed by inflation, shortages, and instability. War is not an investing strategy. It's a market condition. And market conditions reward preparation, not denial. Let's summarize the assets that historically benefit most during war. Gold and precious metals for stability and currency protection. Oil and energy for supply shocks and military demand. Defense stocks for government spending, industrial commodities for infrastructure and weapons. Agricultural commodities for food security. Cybersecurity and defense tech for modern warfare. These are not hype assets. They are wartime necessities. One last thing. This is not financial advice. This is historical pattern recognition. Every war is different, but human behavior is consistent. Fear rises, governments spend, supplies tighten, capital moves to safety and necessity. If you understand that cycle, you're already ahead of most people. So the real question is not, is it right to profit during war? The question is, will you protect your financial future or let chaos decide it for you? Because markets don't care about opinions. They care about where money goes next. If this video helped you understand how money moves during global conflict, subscribe for more.